Hi there, this is Don Brunner with another Back to Business program. Today we're having a continuation of our cash flow management and we'll be discussing how to avoid locking in assets. This is something probably not many have given much consideration to, but one which we hope that you'll find very useful in your current businesses. With that, we'll just move on. When we talk about locked in assets, what do we mean? Well, we're talking about assets which are allocated and precluded from being directly employed for the production of money and used as operating funds. What are some examples? Examples would be facilities, could be equipment, slow-moving inventories, or non-producing receivables. One of the biggest locked-in assets that you can possibly have is the employee expense. Now, we're making a distinction here. We're really talking about non-direct labor. Direct labor is really a productive asset already, but when we're talking about non-direct labor, we might be talking about something like a billing clerk. We might be talking about a credit and collections manager, or a sales manager, or something on that order. But again, wages and labor will constitute anything from 30 to 50% of the total expenses of a business, depending on what it is. And to the extent possible, you want to minimize that labor. How might you do it? Well, if we're talking about the non-direct labor again, we want to multitask. You could have a billing clerk be a collection agent. You could have your sales manager be even the credit manager. Who knows? But at any rate, multitask to the extent that you can and avoid adding employees because they're fixed costs relatively. Watch them very closely. Inventories can represent a very significant item on your balance sheet. It's also one of the most difficult things to control and can conceal a lot of locked-in assets. They're difficult to control because of the number of items, and again, the devil is in the details. When you look at it as a total number on the balance sheet, it may look okay, but when you drill down in and start to look at each individual items, all of those little items can add up to a very significant part. You also are always under pressure from the salesman and the customers themselves to add items that you otherwise might prefer not to stock. And sometimes vendor purchasing terms can dictate to some extent what you have to order and when. One of the best ways to do it is to use the best and most flexible software that you can. Use something that you can drill down to the details and you can extract all of the different things you might want to look at. And again, many times the things that you want to look at they're not even known at the time. You may decide to look at something and get a completely unique view. And again, add special items only when you can be covered by orders from the customers. That sometimes solves a lot of problems. Our next item that can contain significant locked-in assets are receivables. Many of the characteristics of receivables are the same as those as in inventories. They're difficult to control, again, because the devil is in the details, and the details are hidden in the totals. Constant attention has to be required to these as well. You're always under pressure from the sales organizations because they want to make their sales. Again, the ability to control these or to use the best and most flexible software. You need to be able to slice and dice and take a look at views which sometimes you don't even know what you want to look at or how you want to look at it. Let the competitors service non-performing customers. If your customers aren't performing, get rid of them and replace them with good ones. Slide 6 talks about another very major part of what could be locked-in assets. We're talking about property and facilities. Normally, it's very preferable to lease these rather than to own them. Why? Because most of the time substantial cash down payments are required. They are among the most non-liquid of all the assets on the balance sheet, and they're subject to economic cycles. when you need the money most, that's usually when the markets are down, and that's when you usually can't dispose of them and turn them into cash. If you have to own the property and facilities, it's preferable to be owned as a separate business for the owner, separate and apart from the current business, and only after the operating capital is provided for in the business. The last of our slides talks about machinery and equipment. These, like facilities and property, can also be significant items for locked-in assets. But, unlike facilities and property, these normally are preferable to own rather than to lease. The biggest reason is because they're directly related to the revenue, and they have a relatively short useful life compared to property and facilities. Plus, they're directly expensed over their useful life. Again, purchase them only when the reason for purchasing them pencils out. And again, dispose of them when they're obsolete. Hope you found this useful, and we'll think about it often.